Hello, everyone. It's Christopher Calandra. Thanks for joining me today for the third quarter economic update. I appreciate you taking some time out of your day to listen to some of my thoughts and fill you in on some of the goings on, and there's a lot going on. I know people are still making their way into the presentation, but I did want to begin. As usual, I will take questions. You could use the chat feature, and if time allows towards the end, maybe we could cover some of the questions. But I encourage you, if you have questions, to put them in the chat. If I don't get to them because of the time element today, please know that I'll take note of the questions and follow up with you individually. I wanted to begin today's presentation with a quote, which I typically do. It's from Sir John Templeton, a legendary investor. The quote is, "The four most dangerous words in investing are, 'This time it's different.'" And I think as we go through this presentation and I make some of the points that I would like to make to you, this quote will become applicable. The agenda is to talk about inflation, the central issue. We're going to talk about interest rates, recession concerns, the geopolitical unrest. I want to summarize several reasons to worry. Then I want to switch gears and talk about some causes for optimism that I have, and provide a market outlook, including some really powerful historic information that I think you'll find valuable, and then we'll kind of wrap up with key takeaways. I want to begin by discussing what you probably already know, and that is the market indexes are in bear market territory. That is defined as a drop of 20% or more. It's been a very difficult year. The first quarter was not good. Second quarter was not good. The third quarter started out okay with a strong July, but then August wasn't good and September was really not good. So where we find ourselves at the end of the third quarter is the NASDAQ down almost 32.5%, the S&P down almost 24%, the Dow Jones Industrial Average down just about 21%, and the Bloomberg U.S. Credit Index, which is bonds. It's kind of an index that doesn't get as much attention as the stock market indexes, but it's notable because it's down 18%. It's notable because, as most of you probably know, bonds are generally less risky, less volatile. You have a lower expected return over time. In exchange for that, you don't expect to absorb big losses or have very negative years. And of course, that has not happened this year. Bonds have done incredibly bad this year. In fact, that looks an awful lot like a return you'd expect from the stock market. It's almost indistinguishable from the stock market indexes. There's been very little place to hide this year. There's been a lot of selling, a lot of losses. There's a few areas, energy as an example, that has done okay this year, but that's a relatively small percentage of the overall market. Very, very difficult year. So let's talk about some of the reasons. And as I stated at the agenda slide, the big central issue is inflation. We have the type of inflation we have not seen in 40 years. You all know this. The media is talking about it, the national media, the local media, politicians, and you see it in your everyday lives. As you go to the grocery store, you see food prices are up dramatically. Utility bills are up. Energy prices are up. Although gas has come down off its highs that we saw at the beginning of the summer, they're still quite a bit higher than at the beginning of 2021. We have inflation in other areas, including housing, although that's cooled off some recently. Rents, if you're a renter, rents are up significantly. We also have other areas such as hotels, airline fees, tickets. All of these things are contributing to inflation. And in a timely way, I'm glad we're doing this because today, this morning, the government put out the inflation numbers for September, and they were worse than expected. It was 0.4% month over month, over 8% compared to September last year, and it is another sign that inflation has yet to crest. It's still at very high levels. And the trouble with today's number is that there was expectations that it would be a little bit better. We're going to talk about why there's some of those expectations, but it involves the Federal Reserve raising interest rates. I'm going to cover that in a couple of slides. But the expectation was for a better number that was posted today. Yesterday, or maybe it was the day before, the government also put out the PPI number, the Producer Price Index. That's the tracking of the cost that businesses pay to get their goods and inventory. And that was up also 0.4% and also worse than expected. So the inflation issue is a big issue. It's been with us a while. It's a very stubborn issue. It has everyone on edge, and it is causing problems in the economy and by extension in the markets. And this slide shows you the history of inflation. We see, if you look at the far right, how it has just spiked here after a very tame period beginning in, the early to mid 80s. It seems pretty tame along the way, especially since the Great Recession. So this is really a notable inflationary experience that we are having now, and it's a vexing problem, and the government, the executive branch, Congress, and the Federal Reserve, whose primary mission it is to handle inflation, they're having a lot of trouble dealing with this. I want to point out, and the definition of inflation, the classic definition of inflation, is too much money chasing too few goods. And too much money, I want to show you this. This shows the amount of money in circulation in the U.S. going all the way back to 1959. And you can see that consistently the amount of currency in circulation has increased. And the trend was accelerating over time. But when you look at 2020 to where we are now, it's almost a straight line up. There is a massive amount of money that was put into the U.S. system over the last couple of years. It started with the Trump administration, and it has continued with the Biden administration. So this represents something that I think doesn't get enough attention in the public dialogue, is the amount of money that's in circulation, because that is a good representation of too much money, perhaps, in the inflation definition. And it's part of, if you think about it, what happened with housing, as an example, where prices went up rapidly and people were throwing money at houses in a way that seems a little reckless. And maybe it is, but I thought all along that that was an extension of all the money at play. There's a lot of people had a lot of money. There was a lot of money in the system, and a lot of people chose to deploy that in the homes. And they were not very disciplined on price many times, bidding values up. But this is an important consideration in the inflation story. This, of course, is paired with the supply side of that definition. Too much money chasing too few goods. Well, the supply chains in the U.S. and around the world still have not recovered to where they were before the pandemic. The shutdowns, all the dislocation that happened during the pandemic has really led to a situation, even though we're somewhat far removed from the height of the pandemic when it was at its most intense, supply chains still haven't recovered. It's still a work in progress. China still has difficulties. They're still doing lockdowns. This has led to some distortions in the labor market. All of these things have contributed to supply not increasing in many, many instances to keep pace with the currency and circulation increase. And in lots of instances, you actually have supply chain decreases, making matters worse. And this, to me, is why we primarily have inflation. This money story doesn't get the attention it deserves because it really is central to what the country is confronted with as it tries to handle the inflation issue. Speaking of handling the inflation issue, what the Federal Reserve is doing to attack the inflation problem is raising interest rates. And they are very aggressive in raising interest rates. At the last meeting, they raised interest rates 0.75%. That was the third meeting in a row that they raised interest rates 0.75%. So they're raising them routinely, at every meeting, which is, I think, every other month. And they're forecasting that they're going to raise interest rates even more before the end of the year. Conventional wisdom is that the Federal Reserve at the next meeting in November is likely to raise interest rates another 0.75%. There's a little bit of a mix of conventional wisdom for the increase after that, the December one. It ranges between another half point, maybe 0.75%. After today's surprisingly bad inflation number, I read some reports talking about how the Fed may raise interest rates 1% next time. If you think about this, I know you don't follow this probably as close as I do, is over the last generation, the Fed has mostly moved in 0.25% increments. They're moving much more aggressively this time, 3 times as fast as they usually would move over the last generation, because they are very much behind. They were a little slow to act. Inflation got way hotter than they originally envisioned. So they're playing a game of catch-up. And when you're playing catch-up, you have to be more aggressive and go faster. And that has a lot of risks associated with it. But for the time being, they're doing what they feel is necessary to get the inflation numbers to crest and to turn over and begin to trend down. We thought we might see it in September. It didn't happen. And we thought we would see, when I say we in September, when the numbers came out in September for August, we thought we would see some progress, and we didn't. In fact, that's part of the reason why the month of September was so rough for the markets. And then you see again, October's release of the September data, it's worse than expected. So the Fed is going fast. They're trying to catch up. They're very aggressive, but they really haven't gotten the desired effect yet. At least it's not showing up in the numbers yet. This slide is a good representation of what's happened with interest rates. You take the 2022 Treasury yield comparison. You look at where we were at the beginning of the year. Let's start with the 10-year Treasury, which is kind of a bellwether way to look at the bond market. At the beginning of the year, it was 0.93% for yield. When you look at the end of September, at the end of the third quarter, that jumped all the way to 3.88%. I mean, rounding it, it went from 1 to 4. It's an incredibly big jump in just a couple of months, 9 months, 10 months. When you look at the 5-year, the shorter end of the what's called the yield curve, shorter term data, it went from 0.36 all the way to 4. Big jump, big jump. And then there's still increases at the 20 and 30 year. So the interest rate environment has changed dramatically over the last couple of years. And for you, you'll see this with your bank accounts. You're finally getting bank accounts that are paying 2.5%, especially if you use an online bank, which we recommend generally for emergency fund and long-term bank savings kind of stuff. So that's the Treasury yield. Now, the Fed is raising interest rates. It's important to understand the Fed is raising interest rates to head off inflation. What they're trying to do is to suck up some of that excess liquidity I showed you with the currency slide. They're trying to get some of the liquidity out of the system. And they're trying to slow down economic growth, which is a little tricky because when you slow down economic growth, you can trigger the economy into a recession. So there are notable recession concerns. Now, I think technically we are in a recession. I've been in the business for over 30 years. My definition, the definition that I was taught and was always in play, was that if you had 2 negative quarters of GDP growth where it shrunk, that's a recession. And we had that in the first quarter and the second quarter. Now, some people are saying it's not a recession, and I'm willing to acknowledge they have some good points because the job market is very strong, and a weaker job market usually accompanies a recession. But setting aside the technical, are we in a recession or not in a recession, I think we could all agree that there are significant concerns that the U.S. economy is slowing, is not doing very good on the growth front, and we're either in a recession or likely to be in a recession because of the Fed's aggressive interest rate activity that shows no signs of letting up anytime soon. And all of these 3 factors we've talked about so far, inflation, which is ever present in our lives, the rising interest rates, concerns over a recession, including how long is it going to last, when's it going to get here, will it be a shallow recession, will it be a deeper recession, has led to the American public being in a little bit of a sour mood and a little bit pessimistic. Another contribution to this kind of negative atmosphere we're dealing with is the geopolitical unrest. And it may not affect our lives every single day because it's a war in Europe far away. I mean, probably none of us have been to Ukraine or Russia, although I think Tom is on this call and I believe he was in Russia. But generally speaking, it's not a place any of us have been to. And this started in February, and it has lasted longer than I would have thought. I thought it would last a couple of months and then get wrapped up, but it's lasted longer. And recently you have Vladimir Putin saber-rattling, threatening using nukes, I guess is the best way to say it. And you had President Biden having to come out and talk about using the word Armageddon. You know, this doesn't help the outlook. Even if you don't get an escalation of the war, even if you don't get nuclear war, which, God willing, is not going to happen, you know, all of this talk just simply does not help with the mood, the atmosphere that we're dealing with. Just generally unhelpful. And that's not even acknowledging the loss of lives in Russia, in Ukraine, on both sides. It's just terrible. And related to that is the saber rattling that China is doing with Taiwan. There has not been any shooting yet, but it is something that has been an area of worry for a long time, but it seems to have intensified recently with China being a bit menacing towards Taiwan. And of course, that is something to be scared of if China ever acted strongly against Taiwan. But hopefully not, and it hasn't happened yet, so that's a bit of good news. So just to summarize, reasons to worry, and they're pretty powerful reasons, but we have continued inflation, we have rising interest rates, and those 2 factors create an environment with a lot of recession risks. Again, technically I think we're in a recession, but it may worsen, and it may last a while, and it's certainly going to be talked about in the public square quite a bit moving forward. And these reasons to worry center around the confidence in the Federal Reserve. The Federal Reserve has a very, very difficult situation to try and deal with today, partly of their own making, because as I said earlier, they waited too long to tackle inflation. I think that is pretty obvious. You may remember them talking about inflation being transitory, that it was going to be temporary. I mean, they completely missed that estimate. I mean, they were very, very wrong. And so you have to have confidence in the Fed, and it's not clear that they're deserving of confidence, although we don't really have a choice. They're gonna be involved in this because they were so wrong early on, and they're so behind the curve now. There is the worry too that they continue to raise interest rates and they continue to be aggressive to try and catch up. They might overshoot the mark though, and keep raising rates, keep being aggressive, even after inflation is tamed a bit, because it'll take a little while to show up in the numbers. So the Fed has a very difficult, definitely a difficult thing they are dealing with. Related to that is confidence in the White House. Most of President Biden's polling is kind of weak. The expectations are that the Republicans will do well in the midterm elections. I think it's highly likely that the Republicans take over the House of Representatives. I think that's generally agreed upon, although we'll have to see how the election plays out. The Senate is a little more evenly split as to what's going to happen. I believe that the Republicans will win the Senate also. My guess would be they end up with a 52-48 majority. So I believe they'll make some inroads. And when you think about the White House, they have not really garnered a lot of confidence in dealing with inflation. And we could debate as citizens whether his policies are right or wrong, helpful, this, that, the other thing. I'd love to debate that with you. I like that topic. Respectful, open debate. I think, though, setting that aside, whether you really like the president or you really dislike the president, generally speaking, the country doesn't have a lot of confidence in the White House when it comes to the economy. There's ample polling that bears this out. And so it would be helpful if the White House can earn some confidence, maybe make some decisions that are well received. And short of that, though, if that doesn't happen, and it hasn't happened, in my opinion, it's another reason to worry that the Fed and the White House are not getting a lot of confidence in the U.S. today. So let me switch gears. Let me switch gears and talk about some causes for optimism. These are important reasons to be optimistic. I want to talk about the midterm election some more. I touched on it just a moment ago. I want to talk about the history of the fourth quarter. I want to touch on the history of bear market recoveries, and I want to touch on the long-term performance of the stock market and the probabilities of returns over time. To begin with, it's important to note that we're in the fourth quarter, and historically, from 1950 to 2019, the fourth quarter was the best quarter for the S&P 500. Let's just more broadly call that the stock market. The average return over that period in the fourth quarter was 3.9%. The next best quarter, as you could see on the far left, was the first quarter, plus 2.4. The third quarter, historically, is the worst quarter, and we definitely had a rough third quarter this year. 78% of the time, the fourth quarter was positive. So we have, based on history, an 8 in 10 chance that the fourth quarter is positive. That is a cause for some optimism, cautious optimism, but I like this statistic, and I think there's a good chance that we could finish the year on a positive note, maybe making some good progress in the fourth quarter, despite this bad inflation news and the unnerving rise of interest rates. Bear market recoveries. As I've talked about in previous forums with you all, other webinars, the Simply Financial podcasts, my monthly mailing, bear markets are always uncomfortable, but they are normal. This is normal. We hate it. We don't like it. It's upsetting, but it is normal. So when you look back over this previous generation or two, you could see on the left the dates of the bear market low. Now, we don't know if we got to the low in the market yet. I think we're closer to the bottom than the top. I don't know exactly if the market bottomed, but from the bear market low, 1 year after, you could see the returns there in that column, and the average return 1 year after a bear market low is 44%. Does that mean that this time will be the average? Could it be better? Could it be worse? Yeah, it could be any of those things. We also may be a long way from getting to the bottom. But I want to draw you back to the quote I started with, Sir John Templeton's quote about the dangerous 4 words, "This time is different." A lot of people, it seems to me, are thinking that we can't recover. You know, maybe they don't like the president. Maybe they think that this time is different because of inflation, because of the country being split, because of technology, any number of reasons. But the reason why I chose to use Templeton's quote is because I don't think this time is different. I don't think this time is different. I think that this bear market will give birth to a new bull market, and we will have a period following this very difficult one where we are in store for positive gains. I can't guarantee it, but this historical data that I'm going to share, that I've shared with you and I'm going to share in the next couple of slides, really gives me confidence. 3 years after the bear market low date, the average return is 16.5. 5 years after, average return 14+% per year. 10 years after, 9.7% each year. Again, none of these are guarantees, but this historic profile, I think, is important to recognize. I shared this slide with some of you already. I've been using this a lot, but if you look at the S&P 500 from 1926 through 2021, there were 71 positive years and 25 negative years. So it's about a 3-to-1 ratio of good years to negative years. That really is stacking the odds in your favor of getting a good return by being in the market over the long term. During the positive years, the average return is 21.3%, again, from 1926 through 2021. And when the market is down, the negative years are 13.2%. Rough stuff. When you blend that all together, the positive years and the negative years, you end up with an average return over that 96-year period of 10.5%. Pretty good return, but you had to deal with some rough years along the way, as well as some really good years where you shouldn't get too excited. The last of the slides that I want to share to give you a historic perspective is this one, which talks about the probability of positive returns. So this goes back to 1937, and if you look in the far left, on any given day, it's basically a coin flip as to whether the market will be up or down. It's about 53% likelihood of it being up on any given day. But the thing is, as you stack time on, more days, more months, get to 1 year, then stack on more years, you greatly increase the likelihood that you have a positive return. And I'm not talking about 30, 40, 50, 60 years, but if you give it a 5-year period, the likelihood of getting a positive return is north of 92%. 10 years, it's north of 97%. Even at just 3 years, plus 87% probability you'll have positive returns. So the causes for optimism are fourth quarter, historically, is the best quarter. When you look at how markets come off the bottoms of bear markets, it's very reassuring that history teaching us that you're in store for very good returns if you can make it through the bear market. And when you look at the long-term performance of the market, about 3-to-1 good years to bad years, and about 50% more return in the good years versus the negative years, that's quite the incentive to stay invested and stay involved over the long term. And then lastly, the probability of returns. The more time you give yourself, the greater the likelihood is that you'll end up with a positive return. These are reasons I think we can all, this is the reason why, in large part, I am optimistic that our investment strategy, even what I am doing with my own money, will work. It will work, even though this is a really tough episode and there's a lot of negativity around. So to summarize, let's talk about the key takeaways. Caution. Still want to be cautious. There's a lot of going on in this country and around the world. So caution, I think, is still a good idea. Inflation, it continues to be a catalyst for concern, and it will continue to be a catalyst for concern. This is something that will be top of mind for a while. Even when we get inflation to eventually level off and come down, it's going to take probably quite a while to get back to what we had been accustomed to over the last 5, 10, 12 years. Interest rates look like they will continue to rise. All indications are that the Federal Reserve is still in an aggressive posture and will continue to raise interest rates for a while, and they will be aggressive in raising rates, maybe half point, 3/4 of a point, maybe even 1 percentage point at a time, or 1% at a time, I should say. As we talked about, we are in recession territory. Wall of worry. I talked about this in the mid-year economic update back in July. This is the idea that the market can mount a recovery, sometimes a strong recovery, even in the face of negative news and a lot of bad news. And I thought when I introduced this topic in late June and in July of this year, that the market in the second half of the year could climb the wall of worry, even though there's a lot of bad news. That didn't work out in the third quarter, not at all. We're up in the fourth quarter so far a little bit. We're having a nice day in the market today, but it's only one day, so whatever. But I do believe that the market has a good chance to climb the wall of worry over the next months and quarters and beyond, and that would allow us to get past the bear market and get into a new bull market. So we're going to stick with the idea that long-term investing is a key strategy. That's what we're going to be doing, and I think it will work. Remember that we are here to help you. We want to serve you as best we can. Obviously, we don't control the markets. We do the best we can, and we're sensitive to how difficult it is when things are not working out like they haven't this year. But let's talk a little bit about what you can expect from us. And I'm going to finish up within the next 5 minutes or so. So stay with me, please. What can you expect from us? And this is something I've talked about before, but we want to regularly review changes that may affect you. We want to stay on top of things. We want to have regular communications with you. That takes many different forms. This webinar, our monthly mailing, the weekly podcast, Simply Financial, calls, emails, meetings with you, either in person, over the phone, or via Zoom. We constantly are reviewing economic, tax, estate, and investment issues for you so that we could hopefully make as many good decisions as possible to help you achieve your goals. I do have a request, and that is to help us help others, given the difficulties in the marketplace. A lot of people are looking for information, answers, reassurance. So if you know anyone that you care about, that you know, that would be open to maybe a second opinion, maybe some help, a conversation, a fresh perspective, please, please, please know that we would welcome an introduction and would be very flattered if you would be open to doing that for us. And I think it would be beneficial for the people that you introduce to us, because we're going to try very hard to help them. This is standard slide when I end these webinars. Your wealth, your health, and your well-being is our highest priority. I really appreciate, the team and I really appreciate the opportunity to help you with your financial needs. We are always planning for your success. So I want to, again, thank everyone. Thank everyone for taking some time out of your day to listen to this. I wish I was giving better news, because sometimes I feel like the Grim Reaper these days. But we're going to be okay. We're going to be okay, and this will pass as well. So if you have any questions, comments, or anything pertaining to your own personal situation, please reach out to us. Call, shoot us an email. That would be great. I went a little bit longer, which I am prone to do. I shoot off my mouth. So I'm going to not take any of the questions. There are a few in the chat, but I'll address those individually. So we'll leave it there. Again, thank you for joining, and I hope everyone has a very, very good end to 2022. Have a great day.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.